You've seen the memes, you've heard the advice screamed on crypto Twitter. Just hodl, diamond hands. And look, I get it. It's catchy. It's become this daddle cry. But let's be real for a second. For a lot of people, hodl has become a cop-out. It's an excuse to buy something they don't understand, close the app, and just hope. It's not a strategy, it's a prayer. And for every one person who got lucky with that, there are 1,000 others still holding bags of projects that have been dead for years, just waiting for a miracle. So what if we changed that? What if hodling wasn't about blind faith, but about having a real solid plan? A method that lets you watch the market crash 80% and not even flinch because you know what you own and why you own it. That's what we're calling HODLing 2.0. This isn't buy and pray, it's buy and understand. And that's what we're breaking down in the next few minutes. The pillars of HODLing 2.0, the foundation. All right, so strategic long-term investing, it's not just one thing you do, it's a system. And it's built on 3 core pillars. Think of this as your foundation. Pillar 1, conviction through research, the why. This is the big one. You don't hodl a ticker symbol. You hodl a belief in a technology, a team, a vision. Your conviction has to be so rock solid that it can weather a 50% drop without you panicking and selling at the bottom. This is where the work from our Crypto Hall of Fame lecture comes in. What problem does this actually solve? Is the team building? Is the community real? If you can't answer these questions, you're not investing, you're gambling, and you shouldn't be hodling. Pillar 2. Tiered portfolio allocation, the what. You can't just throw money at 10 different coins and call it a day. You need structure. You need to bucket your investments based on risk. Tier 1, the foundation, 60 to 70% of your portfolio. This is your bedrock, your crypto hall of fame. For almost everyone, this is Bitcoin and Ethereum. They're the least risky, in crypto terms, which is still risky, and have the strongest conviction. This is the part that sleeps easy at night. Tier 2, the growth engine. These are your established altcoins. Think projects like Solana, Avalanche, Polkadot, ones with real utility and strong ecosystems. You believe in them, but you know they carry more risk than BTC or ETH. Tier 3, the speculative moonshot, 5 to 10% max. This is your what-if money, the early stage degen plays, the microcaps. You go into this bucket mentally prepared to lose every single dollar. It's a calculated gamble, not your life savings. Pillar 3, active inactivity. This sounds like a contradiction, but stick with me. HODLing isn't passive. It's actively choosing to do nothing. It's the discipline to hold through insane volatility because your research and your thesis are still intact. But, and this is key, it's also having the awareness to know when that thesis has broken. It's not about being lazy, it's about being patient and disciplined. Okay, this is the part everyone asks for. What do I actually do? When do I sell? Here's the system. The quarterly portfolio review. Stop checking your portfolio every day. Seriously, you're just emotional whiplash. Instead, you schedule a formal review. Once every 3 months, you block out an hour, you open your spreadsheet, and you ask yourself these questions. Is my original thesis still valid? Has the project delivered on its promises? Has a competitor come along and made it completely obsolete? Like, if you bought a project because it had the best scaling solution, but then Ethereum nails its scaling upgrades, your thesis might be broken. Has the risk profile changed? Did that Tier 3 moonshot you bought actually take off and become a legitimate Tier 2 contender? Amazing! Maybe it's time to take some profits off the table and rebalance. Is my allocation totally out of whack? This is huge. If your Tier 3 moonshot does a 10x, it might now be 40% of your portfolio instead of 10%. That's dangerous concentration risk. This is where you rebalance. You sell a portion of that winner and use the profits to buy more of your Tier 1 assets. Get back to your target allocation. This is the magic trick. You're systematically selling high and buying low without even trying to time the market. So the only three reasons to sell a long-term hold: your investment thesis is broken, the tech failed, the team quit, something fundamental changed. You need to rebalance to maintain your target risk levels, or you hit a predefined financial goal. You said, if this $1,000 turns into $25,000, I'm taking out $10,000 to pay off my debt. You execute the plan. That's taking profits with purpose. Advanced HODLing, making your assets work for you. HODLing 2.0 isn't just about watching the price go up. It's about making your idle assets work for you. This is how you accelerate the whole process. Staking. If you're holding proof of stake coins like ETH, SOL, or ADA, you should almost certainly be staking them. It's like earning dividends on your stocks. You're getting paid in more crypto just for holding and helping secure the network. The power of compounding. This is the secret sauce. Don't just take your staking rewards and spend them. Restake them. By compounding your rewards, you're slowly but surely increasing the number of coins you own. Over years, this effect is massive. It's a silent wealth builder. Quick word of caution on DeFi yield farming. Those crazy high APY numbers are tempting, I know, but for your core long-term HODL bags, often the simplicity and security of native staking is way better than diving into complex DeFi strategies with impermanent loss and smart contract risk. Don't get greedy and risk your foundation for a few extra percent. The psychology of the long game. Let's be honest, the final boss in all of this isn't the market. It's you, your own psychology. You will see some random coin you don't own pump 1,000%. You will see your portfolio get cut in half in a week. Your strategy is your anchor. Your quarterly review is your compass. Remember this: you will not catch every pump. Embrace the power of missing out. Your goal is steady, managed growth, not winning a lottery ticket. Time in the market beats timing the market every single time. Consistently adding to your positions over time, a strategy we're diving into next, is infinitely more powerful than trying to be a hero and call the bottom. Focus on accumulating coins, not just dollar value. In a bear market, your goal is to stack more sats, more ETH, more of your core assets. In a bull market, your goal is to protect the dollar value you've gained. So HODLing 2.0, it transforms you from a passive spectator into, let's call it, the CEO of your crypto portfolio. You're not praying, you're executing a plan based on research, structure, and disciplined review. You've got your vault. You're filling it strategically. But here's the big next question. How do you actually build that portfolio over time without risking it all at the worst possible moment? That is the million-dollar question. And honestly, the answer is almost boringly simple. In our next lecture, we're covering the single most effective, psychologically easy, and statistically powerful investment strategy ever created. It's called DCA, the boring but brilliant strategy that beats the experts. It is the perfect partner to everything we learned today. If you're ready to stop gambling and actually build, you do not want to miss this one. I'll see you there. And just real quick, a quick and important note, I am not a financial advisor. This is all for educational purposes. Crypto is risky. Please, please, please do your own research and never invest more than you can afford to lose.